Hello everyone, happy Friday. Welcome to Within the Frame, where we delve deeper into the top stories taking place not only in South Korea but across the globe. I'm Kim Bo-kyung. On Friday, South Korea's central bank had this year's very first rate-setting monetary policy board meeting. There, it delivered a quarter percentage point interest rate hike, which lifted the benchmark rate to 3.5%, marking the seventh straight rate increase. First, let's take a listen to what Bank of Korea Governor Lee Chung-Ang said today.
The Bank of Korea's Monetary Policy Board decided today to raise the base rate by 25 basis points from 3.25% to 3.5%. Though the domestic economic growth for this year is expected to be below the previous forecast, the Board of Judges thought the additional 25 basis point hike would be necessary to ensure price stability, as inflation still remains high and is projected to be above the target level for a considerable time.
So, ensuring price stability to contain inflation seems to be central bank's top priority. However, those efforts to contain inflation add to the burden on households and companies already suffering from high interest rates on loans and mortgages. Will another rate hike be able to contain the inflation? What impact would it have on those with large loans amid the slumping housing market? And will the hikes ever stop? For an in-depth analysis on today's rate hike and the U.S. Federal Reserve's decision slated for the end of this month, we invited Professor Song Soo-young from Chung-Ang University on the line. Hello, Professor Song. Welcome to the show.
Yeah, thank you for inviting me, and good evening to you, Bo-kyung, and Professor Lee.
Great. And we also have Lee Munseob, Assistant Professor at UC San Diego School of Global Policy and Strategy on the line from California. Professor Lee, thank you so much for your time.
Thanks for having me.
All right, first question to you, Professor Song. The Bank of Korea's rate hike was mainly to contain the still high inflation. Consumer prices rose 5% on year in December, showing a slowdown from the 6.3% spike in July, but that's still too high for the BOK. Would today's rate hike possibly lead to what the central bank is expecting?
Yeah, 2 months ago, actually, chairperson of the Bank of Korea, Lee, has mentioned that the 3.5% would be maybe the highest interest rate for the Bank of Korea's. And today, he raised 25 basis points. So, which means, despite we have witnessed clearly the slowing of the inflation rate for the Korea. But in months ago, actually, the reason why, the excuse for increasing the interest rate is because in Korea, even though the inflation rate is lower than United States, then in Korea we have the rent equivalent housing price is not included. So that's why he emphasized that Korea's inflation is very high. But recently we know that the Korea's real estate market has shown really declining trend. Then still, he insists upon the increasing of interest rate. Of course, it's lower than 50 basis point. It is better, and so I hope that there would be no further inflation rate, because definitely it will cause a recession for the Korean economy.
Right. Let's talk about what impact such a hike could bring, Professor Lee. Though it was a baby step, it is another rate hike. So how will this impact household loans and corporate borrowing, as those with loans are already struggling due to previous rate hikes?
The last year, the household loans extended by the banks in Korea declined for the first time in 18 years. And it was due mainly to the increase in the borrowing cost. So the BOK's decision today will facilitate this decline further. And I interpret this as the good sign, because it will reduce the household debt and it will slow down the housing market that has been overheated during the pandemic. So regarding the corporate lendings, so we have seen the steady increase in the corporate borrowings in the last year. I think the 25 basis point increase, its impact on the corporate borrowings at this moment would be small.
Right. Now, Professor Song, higher borrowing rates have resulted in a fall in housing prices. And though the government has put efforts for the soft landing in housing market, would this rate hike for today again lead prices to fall further?
As Professor Lee mentioned, that at least there is a good sign, 25 basis point increase, and that could reduce some overheated housing market in Korea. That is, and the loan would be reduced. So that says that is going to be one good aspect of the current monetary policy. But however, we have to take into account always the cost and benefits. So that is Professor Lee's perspective is benefit, but I would like to emphasize the cost would be very great because the recession would be most likely damage on the Korean economy. But the reason, basically, the year-on-year consumer price index in Korea is just 5%, and for the last December, and excluding agricultural products and oils, which is equivalent to some core expenditure price index would be 4.8%. And however, the living necessities are quite expensive, but this is always a very volatile measure of CPI, so we have to exclude that. What is important is what would be the underlying inflation rather than the apparent CPI or some other looks. What would be the underlying inflation? That is a multivariate core trend or some other several types of core trend, which excluding the housing or even when including the housing price, the current housing index would be most valuable and most credible index measures for the understanding the underlying inflation rather than the headline inflation or other CPI is quite deceiving. So to that regard, what I'm very concerned is, of course, stabilizing the housing market is very important, but it could cause a serious recession. That is actually the cost is much bigger than the benefit, and then this would be a quite misleading if we have some further increase of interest rate.
Right, so we need to also consider the underlying inflation like Professor Song said. Mm-hmm. But Professor Lee, I also want to tap on the trade sector, which is one of the important driving forces for our economy. Now, South Korea saw the trade deficit, which saw its new high in 2022. How would another rate hike that was made today affect imports and exports for South Korea?
So while we saw the trade deficit in 2022, the export, the rose, and the reached to an all-time high. But the reason why we saw the trade deficit was because the import increased further, mainly due to the global energy prices. So thinking about the future trajectory of the export, so I think the two major factors are going to play the key roles. The first, when the demand for the chips would be rebounded. Second, how quickly the China would recover from the current pandemic. And those two major factors are not directly affected by our own monetary policy decisions. So in that sense, another hike today, its impact on the import and the export for now would be marginal because there are other external factors we cannot control. Those are playing higher roles.
Right. So for the trade sector, we need to consider the chip rebound and also the China's reopening. Now, Professor Song, the key rate is now set at 3.5%, but given that the Bank of Korea will not want the interest rate gap with the United States to widen too much, is there room for the BOK to deliver another rate hike within this year? And if it does, how high will it be?
Yeah, the reason why they are concerned about the interest rate gap between the U.S. and Korea is basically it could affect negatively against the exchange rate because depreciation of Korean won against the US dollar is always regarded as a favorable sign for the export increase. However, recently the purchase power of US and other European countries and China has reduced a lot. So that had shown the last December's current account deficit in Korea for the last several decades, for the first time, negative current deficit. So that means export price index has been increased only 3.1% year-on-year basis from the previous year's December, but import price index has been quite increased. So to that regard, the balance of trade, which plays a major role in determination of the current account deficit of the Korea, has turns out to be very negative to Korea. So this is not directly, as Professor Lee mentioned, that is not affected and is maybe independent of the determination of the interest rate within domestic market for Bank of Korea. So, however, still what I'm concerned is if the domestic economy is in recess, even though suffer from the recess, as long as the international trade or the export is increased, that could be a signal to recover economy much faster. Otherwise, given the level of the trade has been shrunken, then the domestic economy also suffers from the recess. That is going to be a double dip of the economy, and that would be my most serious concern about that interest rate hike.
Right, very concerning aspect. Professor Song, another question though. There are concerns over the possibility of recession like you kept mentioning. Governor Lee said during a separate talk with reporters that South Korea's economic growth is expected to fall below the latest projection, which was 1.7%, citing the impact of steep rate hikes on the overall economy. When would be the proper timing for South Korea to begin the rate cuts? And should we have to worry about the recession that might hit South Korea?
I do not have much tolerance about the interest rate hike because this is the most appropriate time to stop increasing. Because regardless of whether the Fed increased 25 basis point or 50 basis point in the next month or this, still, we do not have to concern about the exchange rate. So there are a famous trilemma theory about rule about the international trade. The flexible exchange rate and some monetary policy independence and some free capital flow. As long as we cannot control the free capital flow directly, then we have to give up the exchange rate. So we do not have to concern about the interest rate gap between the Korea and the US. Still, even the exchange rate has recently shown that it is a little bit appreciated for the Korean won against the US dollars, which is hovering around the 1,300 won. And so that is very good. But BOK and the Korean or Minister of the Planning and whatever finance, they do not have to worry about the interest rate between the US and Korea at all. All they have to concern is the economic recess in domestic market. That is, I would like to emphasize. Clearly, we have seen that some wage rate is decreasing for Korea. In the U.S., later I'm going to talk about that, but still, that is my primary concern right now.
Right. So as Professor said, we don't have to worry about the interest rate gap with the United States. But still, I'd like to tap on the Fed's decision that might come at the end of this month. Now, eyes were on the U.S. Consumer Price Index, and according to the U.S. Department of Labor, the index rose 6.5% on year in December, which was the lowest level in 14 months. How did Professor Lee evaluate December CPI, and could we say that inflation overall is being tamed?
So December CPI in the US was released yesterday, and it was in line with the market's expectation. So monthly inflation rate was the negative 0.1%. And the last time we saw the negative monthly inflation rate in the US was in May 2022. when the 2020. So when the consumer demand collapsed due to the pandemic. So inflation is definitely the moderating, the steadily and quickly. But the current annual inflation rate of 6.5% is still far higher than the Fed's target rate of 2%. So the Fed will definitely keep conducting tightening monetary policy to keep the inflation expectation under the control.
Right. Professor Lee, I want to ask you one more. But recently, the U.S. labor market has proved to be strong, though, with the U.S. unemployment rate at 3.5%, while non-farm payrolls increased by 223,000 people. And some experts say that the job report is showing a so-called Goldilocks sign. What does this Goldilocks sign mean, and what is your takeaway on this?
The Goldilocks scenario refers to the economy that is not too hot or too cold. So that is mostly represented by the modest level of unemployment rate and the modest level of inflation. So that's where we want to go by the soft landing the US economy. So Professor Song described the several costs the Korean economy should pay to tame the inflation. But in the US, given the strong labor market, I believe that we have still more margin to conduct to the raise the interest rate. So I don't expect a severe recession as an outcome of the tightening monetary policy. The Fed did a great job acting fast when they realized inflation is not transitory anymore, and the Fed successfully made the inflation expectation under the control by communicating clearly and firmly. So that definitely prevented us from the worst case scenario. So yeah, let's see how it evolves. But definitely the US has more margin to conduct a further tightening monetary policy compared to Korea.
Oh, right. Like Professor Song, so like Professor Lee said, there is still a margin for the United States to, raise its key rates, and lower CPI along with a robust job market. Such data may make the Fed more likely to go to 25 basis points rather than 50 basis points rate hike at the FOMC meeting scheduled at the end of this month. I want to know, what's the Fed's decision going to be in your opinion?
I believe that I'm a little bit different from opposite opinion of the Professor Lee's perspective, because as I see the CPI, which has culminated in the June 2022, and since then we have witnessed a declining CPI, and for all the items, the headline inflation, excluding the food and energy, that had started a declining trend in September 2022. As I mentioned earlier, that in December, there is in the previous months minus negative 0.1% decrease of the CPI. But however, in the labor market and employment status, 223,000 new jobs are created and offered to the labor market, and overall the wage rate seems to look a little bit very good, and unemployment remains very low at 3.5%. But when we go into details, the story is quite different, because given the level of the average rate, particularly the recovery of the employment rate has been found in some education and health and the leisure and hospitality industry, whose compensation level is much below the average of the hourly wage and the weekly wage altogether. But the highly paid wage industry sectors, such as information technology and then the professional and the business services, such as the financial services, they are engaged in some layoff. However, their payoff is increasing. So combining these together, the actual wage has been declining, and then even though the unemployment rate remains low, still this could tell the U.S. economy is not in the doom situation, but very long-lasting suffering for the lower earning, lower income people. So then is there any other alternative way to avoid this kind of recession only borne by some poor 50% lower people? I don't think so. Many other economists, including Paul Krugman and other economists, renowned economists, there are some other alternatives to control the price rather than incurring the recess overall the economy and with interest rate hike. So this is a little bit cautious approach is necessary, and the very precise approach is necessary. Price control would be the alternative way to overcome without any serious recess for the U.S. economy.
Right, interesting. Now, Professor Lee, I'd like to ask you, out of 21 other central banks monitored by Bloomberg, 10 of them are expected to increase rates, but 9 are projected to cut rates. Could we briefly go over other countries' central banks' outlooks regarding interest rates? And with some countries leaning towards cutting rates, what does that mean?
Sure. So inflation is almost everywhere these days in the global economy. And then Bloomberg projections were for the end of the 2023, not for the upcoming monetary policy decision. So at least in the first half of the 2023, the many countries will still increase the rate to reduce the inflation. And in the second half of the 2023, the several countries will revisit the decision depending on how the labor market and the overall prices evolves. The one exception is China. So China is suffering from the soaring the COVID cases these days, and they have an inflation rate low, but they are suffering from the lack of the consumption and the economic activities. So the People's Bank of China may cut the rate even in the first quarter of the 2023, but that's the exceptional case. And I mean, yeah, so just adding to the Professor Song's point, I'm more in the side of the economists arguing that the recession is necessary. It's not unavoidable to reduce the inflation. So in that sense, many central banks are going to still pay the cost of experiencing the recession to tame down inflation.
All right, it was truly interesting talks with our professors, but unfortunately, this is all the time we have for today's edition. But thank you, Professor Song, for your insights, and of course, thank you, Professor Lee, for your insights as well. We appreciate it.
Thank you, and my pleasure.
All right, that's all for Within the Frame tonight. Have a great rest of the evening and enjoy your weekend. We will be back next Monday with more in-depth stories on the issues happening in South Korea and, of course, around the globe. Thank you for watching, and goodbye.